Here's another one you hear all the time. It's $3. How much can I lose? I've had people call me up saying, I'm thinking of buying this stock at 3. How much can I lose? Well, again, you may need a piece of paper for this, but if you put if you put $20,000 in a stock at 50, or your neighbor put $20,000 at 50 into the stock, and you put $20,000 in at 3, and it goes to 0, you lose exactly the same amount of money, everything. And people say it's 3. How much can I lose? Well, if you put $1 million on it, you can lose $1 million. Just the fact that stock, this may be a reason to research a stock. The fact that stock is 3 down from 100 doesn't mean you should buy it. And in fact, short sellers, people that really make money in stocks, they don't short Walmart, they don't short Home Depot, they don't short the great companies, Johnson & Johnson. They short stocks down from 80 to 7. They'd like to short it at 16 or 22, but they figured out at 7 that this company is going to go to 0. They just haven't blown taps on this thing yet. It's going to 0. And they're selling it short at 7, they're selling it short at 6, at 5, at 4, at 3, at 2, at 1.25. And you know, to sell something short, you need a buyer. Somebody has to buy the damn thing. And you wonder, who's buying this thing? It's these people saying it's 3. How much lower can it go? You know, now, here's a subject that you probably all talked about. Getting close. All right, we'll drop that one out. It's getting very close, so everybody has to go somewhere. So the important thing is you can't get too attached to a stock. You have to understand there's a company behind it. You can't treat this like your grandchildren. No, you have to deal with the stock and say, I understand the company, and if it deteriorates, if the fundamentals slip, you have to say goodbye to it. If one rule you want to remember is the stock does not know you own it. This is a breakthrough. So don't get, you have to understand it and say they're doing well, and as long as they keep doing well, my best stocks have been my 5th, 6th, 7th year I own them, not my 5th, 6th, 7th day. So you have to understand that and stay with it. And then I'll switch through to my my long shots. Avoid long shots. I bought about 30 long shots in my life. I've never broken even on one. The ones that are really bad are what we call whisper stocks. And if Arthur Levitt was here, he'd appreciate these stories. But these are the times that somebody calls you up and say, hi, Peter, how's Carolyn, how are the kids? And I'd like to talk to you about international blivet. And what they have in this company is very good earnings. Earnings going to be very, they're going to be big, small. $3, $1 share. And they keep whispering. They say, what are you talking about? I don't understand it. And these are, now, either they're so surrounded by people that are going to run out and buy this stock because it's so exciting, or they think the SEC is listening in. They'll get a shorter term. They'll get 6 months in the camp rather than 2 years in the camp. But whisper stocks don't work. And then I want to conclude with there's always something to worry about. If you own stocks, there's always something to worry about. You can't get away from it. What happens in the 50s, people were worried about the only reason we got out of the Depression was World War II. We got another recession in the early 50s. They said we're going to go right back into a depression. People worried about a depression in the 50s, and they worried about nuclear war. I mean, back then, the little warheads they had then, they couldn't blow up McLean, West Virginia, or McLean, Virginia, or Charlestown. Now, all these countries that end in STAN, there's 9 of these STAN countries that have come out of Russia. They all have enough warheads to blow the world up, and no one worries about it. When I was a kid, people were building fallout shelters, and we used to have this civil defense drill. Remember this one in high school? You get under your desk. I never thought even then that was a particularly good thing to do. If it blow was somebody put on a hat, we'd all get under our desk. But in the 50s, people wouldn't buy stocks, except for the 80s. The 50s was the best decade, the century of the stock market. And people wouldn't buy stocks in the 50s because they're worried about nuclear war and they're worried about depression. Then people, remember when oil went from 4 to 40 and it was going to go to 100 and we're going to have a depression? Remember that one? Well, about 3 years later, the same experts, now higher paid, oil's now at 10, they said it was going to go to 4 and we're going to have a depression. And then the Japanese, remember how the Japanese were going to own the world? Remember that one? And that we're going to have a depression? And then about 2 years later, we're all worried about Japan collapsing. And this is the most absurd thing I've ever heard. There's a company with a 20% savings rate, incredible workforce, incredible productivity, and people are saying we're going to have a depression because Japan's going to collapse. And they had, on their prayer list, they loaded Mother Teresa and crippled children, and they were praying for Japan at night. It's unbelievable. I mean, the LDC debt. Remember the LDC debt? Remember that one? all these countries, all Chase had lent their net worth to Brazil, Chile, Peru, and all these other countries, and so and all the other countries. And LD said they were not going to pay it back, and we're going to have a depression. It always ends, and we're going to have a depression, or the Great Depression. We have the Great Depression. I never could understand that adjective in front of depression, but the Great Depression, or the big one. The big one's coming. But all these countries, and now I understand, these are called then they were called less developed countries. Now, we used to call them underdeveloped countries. Those are all wrong terms. Those are not politically correct. You have to call these emerging countries. You can't use less developed or underdeveloped because that's, in fact, the other day I heard the politically correct term for somebody that's overweight is laterally challenged. That's so there's always something to worry about. And the key organ in your body in the stock market is your stomach. It's not the brain. If you can add 8 and 8 and get reasonably close to 16, that's the only level of math you need to know. You don't need the area under the curve. Remember that quadratic equation and an integral calculus and the area under the curve? I mean, whoever cared what was under the damn curve? I mean, but you had to study this. You don't need this in the stock market. So all you have to know is you're going to see, it's always going to be scary. There's going to be always something to worry about. And you just have to forget all about it. Cut it all out and own good companies or own turnarounds. Study them and you'll do well. And that's all there is. And I'm ready for questions.
When managing a portfolio, do you pay much attention to the activities of Congress and the regulators?
Did Ed Markey put this one up? I'm not sure. I spend zero time thinking about what's happening down here in Washington. And I spend little time thinking what's going on in Russia or China. I just deal with facts. When the economy's going down, when the economy's going the wrong way, I can deal with that. This whole health care reform bill drove a lot of drug stocks down to low levels. And I could say to myself, well, 60% of Johnson & Johnson's earnings are outside the United States. Their pharmaceutical drug business is all on patent. Nothing's coming off patent. They only have 5% of sales from one product, which is Tylenol, which is already an over-the-counter drug and it's growing overseas. I says, why is this stock gone from 58 to 36? And these companies are already dealing in Japan and overseas with they already have the government controlling pharmaceutical prices. They've dealt with it. So I deal with facts. They might, this year, I thought it was very likely you'd have a bill passed on health care. It didn't happen. They drove the stocks down, but I think the stocks would have rebounded anyway, even if the health care bill was passed. So I don't deal with what's happening in Congress or what's going to happen in the future. I just deal with what's happening in the economy and what's happening in the companies I call.
How useful is the financial reporting in the general daily press to you, and how useful should it be to investors in general?
Okay. It has improved dramatically, not just in the press, but also company reporting. 10 years ago, companies didn't have interim balance sheets. It's hard to imagine. They only gave their balance sheet to you once a year. Now they show you quarterly what's happening in their inventories, what's happening in receivables. In the major newspapers, they'll even show types of funds. There are now, I think there's 2,500 companies in the New York Stock Exchange. There's over 5,000 different mutual funds. So there's twice as many mutual funds as there are stocks. At least in the paper day, explains what kind of fund this fund is. So I think reporting has improved. They report earnings. But again, I think if you own auto stocks, you shouldn't be reading the financial part of the newspaper. On Wednesday, the local newspaper, Tuesday, some places, or on Saturday, they have a whole 4 pages on automobiles. And they talk about new models. And they say this one stinks and this one's outstanding. They really, if you own auto stocks, that's the part of the newspaper you should be in. You shouldn't be calling your broker 4 times a day to get stock quotes. It doesn't work. Getting up in the morning to look to see how your stock did yesterday is not useful. All this stuff is just a waste of time. If you're adding up how much your stocks are worth, absolute waste of time. You should be looking at the company when you get the quarterly reports. You should be, if you're at the mall, imagine if you were in the retailing industry, or if you're in the restaurant industry, you would have seen Taco Bell, you would have seen McDonald's, you would have seen Toys R Us. I mean, you would have seen all these companies do terrifically well. You would have seen Bombay, you would have seen Tandy with Radio Shack, and you would have seen Radio Shack roll across the country, and pretty soon there were 25 Radio Shacks in every major city, and you said, there's not much room for them to go. But they had a 20-year great run. That's what you're dealing with. You're not dealing with the minutia of today. You're dealing, what's this company doing 2 years, 3 years, 4 years, 5 years from now? And if you're dealing with a cyclical and business is turning around, you wait for signs that business is slowing down. When you see it, you move on to something else.
Are you concerned about the volatility in the financial markets today, do you think something needs to be done to reduce it?
I love volatility. I think I remember when in 1972 the market went from down dramatically, and Taco Bell went from 14 to 1. They had no debt. They never had a restaurant close, and I started buying at 7, but I kept on to it, and it went to 1. And it was the largest position in Magellan in 1978 when it was bought out by $42 by Pepsi-Cola. And I think it would have gone to 400 if they didn't buy it out. I think volatility is terrific. I think these callers are very important. I don't think the market going up 80 points one day and down 80 the next is a good thing for the public. I think that's not a very good thing. But I think all of these callers and all these other things, to keep the volatility down each day is important. But the market's going to go up and down. Human nature hasn't changed a lot in 25,000 years. And some event will come out of left field, and the market will go down or the market will go up. So volatility will occur, and markets will continue to have these ups and downs. I think that's a great opportunity if people can understand what they own. If they don't understand what they own, they can own mutual funds, try and figure out mutual funds they own, and keep adding to it. Basically, corporate profits have grown about 8% a year historically. So corporate profits double about every 9 years. The stock market ought to double about every 9 years. So I think the next market's about 3,800 today, 3,700. I'm pretty convinced the next 3,800 points will be up. It won't be down. The next 500 points, the next 600 points, I don't know which way they're going. So the market ought to double in the next 8 or 9 years. It ought to double again in the 8 or 9 years after that. Because profits will go up 8% a year, and stocks will fall. That's all there is to it.
We're in the month of October. Beware of the month of October, the witching month for the stock market. What do you see as the outlook for this month? And when do you think the Dow will hit 4,000?
The October has always been a special month. I remember in 1987, I was very, I was very convinced the market was not in trouble, and I didn't worry about things. And Carol and I had planned this great golf vacation to Ireland, and we're going to visit one course and stay at a little house and visit another, go all along the west coast of Ireland and play golf. And we left on a Thursday night, and the market went down 55 points that day, which was not too good. And the next day we got to Ireland, because of the time difference, we completed our day, and I got back to the hotel and I called in. The market had gone down 112 on Friday. I said to Carolyn, I think if the market goes down on Monday, we're going to have to go back. And so we stayed there for the weekend. And on Monday, the market went down 508 points, and my fund went from, I think, 12 billion to 8 billion. And that gets your attention, in two working days. I said, at the end of this week, I'd be have no fund. Now, there wasn't a lot I could do. I mean, here I was on Monday, because the market didn't open, by 12 o'clock, it was in Ireland, it was still 7 o'clock in New York. So we did spend that day, and we played around golf in the morning, and then we went somewhere and sort of watched the market deteriorate. And I did come back. There wasn't nothing I could do. I mean, just nothing I could do about it. But I think my shareholders, they called up and they said, "Well, what's Lynch doing?" They said, "Well, he's on the 6th hole, and he's he's even par up to now, but he's in a trap. This could be, this could be a triple bogey here. This could be a big inning." And I don't think that's exactly what they want to hear. So I could do something about this damn thing. So I came back home and suffered with everybody else. And fortunately, I was very consistent. The market went down when I ran Magellan. On 13 years, the market went down 9 times, and every time the market went down, Magellan went down. I was 9 for 9, and because it's very important. This is another one of these numbers you ought to write down. If you put $1,000 in a stock, all you can lose is 1,000. I've done that several times, and but if you're right, you can make 5,000, 10,000, 20,000. So this business, you don't have to be right 1 out of 2 times. You can be right 1 out of 4. It's a long time. The times you're right, you know the company's doing well, you know they're doing a great job, and you add to it, or at least you don't sell it, which is a terrible tragedy. So you can make more money on the upside. So I just wrote those out, and I will now flip a coin to tell you where the market will go to 4,000 this year or next year. Heads means it goes up. It's a 2-headed coin. The market will go up in the next year. That's it. That's all I ever know about the stock market.
And there you have it. If in the first part he taught us what to look for, in this second part, Peter Lynch gave us a masterclass on what is perhaps most important: our own psychology as an investor. Think for a second about the lessons he gave us. The idea that the most important organ for investing isn't the brain, but the stomach. The brilliant line that the stock does not know you own it, forcing us to be objective. And the reminder that the market always climbs a wall of worry, whether it's about wars, recessions, or political crises. This is a powerful antidote to the panic we see every day in the news. It's a call to be brave when others are fearful and to focus on facts, not on disaster narratives. Now, the good news is we're on the final stretch. What you just watched was part 2 of our 3-part series with this incredible lecture. We are already working to finish part 3, the grand finale, where he ties all these ideas together and concludes his reasoning. And of course, just like this one, the final video will also be fully subtitled, so you won't miss a thing. Thank you for watching, and we'll see you in the next video to wrap up the series. I hope you enjoyed today's video. If you found the content helpful or engaging, please give it a like, as this helps the video reach more traders like you. And don't forget to subscribe to the channel and turn on notifications so you never miss our latest insights on the markets and practical trading strategies. Sharing this video with your friends or on your social networks can make a big difference and helps our community become stronger. Now, if you want to go even deeper and get access to exclusive content, early video releases, and extra tools to support your journey, consider becoming a member of the Com Lucro Trader community right here on YouTube. It's a way to support our work and a smart investment in your own development. Thanks for watching, and I'll see you in the next video.